Hello, so let's solve an exercise about the US depreciation methods. I'm on page 81, exercise 5B3, this one. So it reads, a machine is purchased for $15,500. Costs of building a foundation, connecting wiring and plumbing, and other installation expenses total $2,500. The machine will be used for 40 years and then sold for $5,000 in year 4. However, it will cost $3,000 to remove the machine, another $1,000 to deliver it to the point of sales. Calculate the depreciation deductions taken in each year, assuming that this machine has a 5-year max class life, using normal, which is the accelerated depreciation method. And this means the US method, okay, because of the max. That's the name of the US method. Next, calculate the net cash flow after taxes resulting from the sale of this machine, using a capital gain tax rate of 28%. So basically we need to compute all the depreciation rates so that we find out the net cash flow after taxes. So it's a quite comprehensive exercise. Let's write the data. So this is page 81, exercise 5B3. So it states that for the basis, basically the summation of all the costs of acquiring and make the machine ready for us to use. It cost $15,500 to buy it. Then foundation, wiring and plumbing and other installation expenses total $2,500. So the cost of this machine that we're going to use as a basis, okay, it's going to be $18,000. That's the reference for depreciation. Then it says that it's going to be sold in year 4 $5,000. But it's going to cost $3,000 to remove the machine, and another $1,000 to deliver it to the point of sale. So the salvage value net is $1,000. Then it says that this is a 5-year class asset, and says to use normal depreciation method. So use US normal depreciation method. So this is a machine, 5-year life, personal property, right? Remember that real property is real estate and personal property is everything else. Then we go to page 67. They said it was a 5-year class life using the normal method. So it falls here in the 5-year class on table 1 with personal property. Then we look for the personal property tables that associated with the normal method. It's not table 2 because this is the alternative method, okay, meaning straight line. And it is table 3, which is the normal method. Okay, so we're going to focus on the 5-year class life. Okay, 5 years, and I'm going to put it right here. So here, and here I'm going to put the depreciation rate from the table. Year 1, year 2. No point in putting year 0 because we just pay depreciation at the end of the year, so that's why I start at 1, 2, 3, 4. It's a 5-year class asset. But I'm just interested in the first 4 years because we're going to sell the machine at year 4. So there is no use to compute the other years. The depreciation rate for the first year is going to be 20%, the second year 32%, the third 19.2%, and the fourth 11.52%. However, for the fourth year, we're not going to be able to record the full amount of depreciation. Why? Because we're selling it in this year. So as the personal property follows the mid-year assumption, we can only record half of this amount, regardless if we are selling it in January 1st or December 31st. Remember, for personal property, it does not matter the day, it does not matter the month. The only thing that matters is the year. So for this year that we are selling it, we're getting rid of it, we can only record half of this amount because it follows the mid-year assumption. So we're going to divide this amount by 2, and this is going to give 0.0576. Okay, half of that amount. Okay, so remember, if we were not selling it prior to the full life of the asset, we would just take the depreciation rates from here up to the last year that we could record depreciation. However, if we sell it prior to the full allowable life, then we need to adjust these depreciation rates to follow the assumption associated with the type of property, which is personal property. So in the moment of sale, if we sell it earlier, then the amount of depreciation we can record for that year is half of what is written on this table. So for year 4, that's the year we're selling it, we were supposed to record 11.52% of depreciation for the entire year, but because we are selling it, we're just recording half of it, and that half is the 0.0576, the same is to say 5.76%. Same thing here. For example, if you were selling it in year 2, for the entire year you were able to record 32% if you were not selling it. But if you are selling it by year 2, then you will only be able to record 16%. And this applies every time you're going to sell it prior to the full allowable life. For the sake of space, I'm going to erase this from here and just write there that number, now that you know where it comes from. Now we're going to find the depreciation amount by multiplying the depreciation rate times the basis, and that's going to be equal to the depreciation amount for a given year. The basis is the 18,000. This is the US method. It's simplified, so we don't care about the salvage value at this point. We just care about the basis. We don't care about the book value at this point, neither. It's the simplified US method. So, for the first year, we can record 20% of that. So $3,600 in depreciation. For the second year, 32% of 18,000, $5,760. For the third year, 19.2% of 18,000, which is 3,456. And for the last year, 5.76%, which is $1,036.80. So if I ask you, what is the amount of depreciation recorded at year 2 for this asset? All that you needed to do was to find this number, 5,760. Another type of question I could make. Okay, so how much was the amount of depreciation recorded in the books up to the moment of sale? So you would add all the depreciation recorded from year 1 to year 4, which is basically the summation of these numbers. And that will be 13,852.80 cents. Okay? So now the question focuses on the net cash flow from salvage value. The net cash flow from salvage value, as we saw in the textbook on page 71, this is the formula. Net cash flow from salvage value equal to the salvage value minus the tax rate times the capital gain or capital loss, where the capital gain or capital loss is equal to the salvage value minus the difference between the basis and the summation of all the depreciation recorded up to that moment in time. Right? So we need a summation of all the depreciation. Let's solve this. So it's equal to the salvage value minus how much we pay in taxes. And how much we pay in taxes is the tax rate times the difference between the salvage value and the book value, where the book value is equal to the basis minus the summation of all the depreciation recorded up to the moment in time. So let's clean this. Okay, so the net cash flow from salvage value, it's equal to the salvage value, which is $1,000. Remember, we sold it for $3,000, but then we spent $2,000 to dismantle it and $1,000 to deliver it. So net, we end up with $1,000 from selling it as a salvage value, right? And then we're going to pay taxes on potential gains, right? So 28% of taxes on the gain that we did, if we did it. And the gain would be assessed by the difference between the salvage value and the book value. So the salvage value again of $1,000 minus the book value is equal to the basis minus all the depreciation recorded in the books up to the moment of sale, which is 13,852.8. So this is going to give us the book value. How much is that book value? So let's just write down here LLs. And the book value would be the difference between 18,000 and 13,852.8, which means that the book value is 4,147.2. Okay. That's the book value. And now the difference between how much we sold it for net, right, and how much the asset is still worth in our books would give us our profits or our losses. Here you can see we're going to have a loss. We just got $1,000 from selling the machine with all other expenses, right? And the asset's still worth about $4,000 in our accounting records. So we had a loss of 3,147.2. This is the capital loss. If this number was positive, that will be the capital gain, right? And that's the typical scenario. We have a gain and we pay taxes on it. In this case, is a curious one. That's why we selected to do this exercise. Because if you have nothing else going on in your company, besides when it comes to selling used machines, then you would stop here, you wouldn't pay no taxes, so you end up with $1,000 in your pocket from selling the machine because you didn't pay any taxes. Right? You have a loss, you don't pay taxes on losses. However, the way the textbook solves the exercise is assuming that there are gains to offset elsewhere. So what the textbook is doing, curiously, is treating this as a tax credit. Because you have profits elsewhere to offset with this loss on. So it's not, in my opinion, the most accurate thing to do, but they are just doing it to highlight that if you have other activities going on related with the sale of used machines, then you could offset these taxes, right? And the tax credit here to offset on other tax obligations will be a multiplication 28% of this amount, right? So that will be about $881. This will be a tax credit. And therefore the answer that the textbook shows is, okay, the net cash flow from here, because the government would pay you $881. That's the extreme assumption. But again, this is done in the textbook to illustrate the possibility of getting a tax credit. Okay, so they declared the solution as 1881. Okay, in real life, although, if this was the only thing going on when it comes to the sale of equipment, you would get $1,000 as the net cash flow because you wouldn't pay taxes. However, if you are sold multiple machines and at the aggregate level you had profits on all the other ones and this was a loss, then you could reduce your tax obligation by $881. Okay, that's what the book is stressing out. So that's it about this exercise, where it shows you, how to play with personal property under the US system. We computed the depreciation rates for every single year, and then we computed the net cash flow. Like I told you in the assignment, that you're going to be tasked with, basically, this question is broken up in three, where I first ask you for what is the depreciation in a specific year. So that's all you need to compute for that. Another type of question is, what was the summation of all the depreciation? So you have to add all the depreciation up to the moment of sale, for example. And the third type of question is this one, which requires everything basically, right? Which is find out what is the net cash flow from salvage value. Okay? And this is the computations you would do. Now let's do a case for a real property, because the real property follows the mid-year assumption. Here was personal property, we followed the mid-month assumption, and now we're going to do an exercise for real property, so you see the difference. So let's do exercise 4 on page 82. It's an industrial building, real property, which costs $2.4 million, was placed into service in August 1999. It will be used until December 31st of the year 2030, when it will be sold for $500,000. Calculate the depreciation to be taken in the years 99, 2000, 2029, and 2030 using the current US tax laws. Calculate the net cash flow after tax resulting from the sale of this building in the year 2030 using a capital gain tax rate of 28%. So let's write down the information. Exercise 5B4 on page 82. Basis 2.4 million, sold for 500K, and they want to know the depreciation for 1999, depreciation for 2000, depreciation for 2029, and depreciation for 2030. They also say that this is sold in the year 2030, and they say that the tax rate is 30%. Now let's add a little extra information. Let's say that they said the estimated salvage value in 2030 to be 1.5 million. I'm adding this information because I want to stress this, and I am stressing this in the assignments I task you with. One thing is to have an estimate for how much you're going to sell it. Another thing is how much you actually sold it for. When we're doing the net cash flow from salvage value, What matters is the true salvage value, the one that was actually realized, not the one that was estimated. So if I was to write in this question, estimated salvage value for 2030 was 1.5 million, but they end up actually selling it only for $500,000, what you would use as salvage value in the formula for net cash flow from salvage value would be the $500,000. If you didn't have this information for how much the asset was actually sold for, then you would use this 1.5 million in the formula for net cash flow for salvage value. However, if you are given this piece of information, which is the estimated value, but also how much the asset is actually sold for, then this one is to neglect. What matters, the true salvage value, is the one that is actually realized. If you have both pieces of information, you stick to this one. If you only have this piece of information, then you use that value. Right? So I'm reinforcing that. If you have the actual selling price, then that's the one that we use as salvage value, not the estimated. One thing is to estimate things, but that does not mean that they're going to become reality. So that's the point I wanted to stress out. So this is to be ignored, and it doesn't show up in the question, right? But I was bringing it here that to contemplate that scenario, that if you have both pieces of information, then you stick to the real one, as highlighted in the textbook. So let's compute the net cash flow from salvage value for the year 2030. Right? And in the meantime, in the process, we answer these intermediary questions. So first thing, we're talking about an industrial building. So if you're talking about an industrial building, we're going to look for non-residential real property. Right? Remember the procedure. First step, when talking about the US method, go to table 1 on page 67. Look for where does the type of asset shows up. So they said on page 82 that it was an industrial building. Right? We're going to look for industrial buildings. So here it says, when it comes to real property, you have residential and non-residential. So an industrial building definitely is not residential, right? So we stick to non-residential. It says building and structures. It doesn't say industrial building literally, but you only have two options, residential and non-residential. So industrial building is non-residential. So we're going to look for the table that says non-residential real property, and there's only one non-residential real property. That's table 4. Okay. So we're going to take the information from here. We're going to need the months. See, it shows up the months, so the months matter. We're going to need the month of sale and the month of purchase. So let's go back to the question and look for that. On page 82, it says that the purchase was, well, it actually doesn't say the purchase when it was. It says when it was placed into service, right? Which is what really matters, because the purchase and the actual usage of the asset, in this case a building, do not need to coincide. And remember, if you have both types of information, meaning you have, let's say here would say that an industrial building was purchased in January of 1999 for 2.4 million and placed into service in August. Well, the month that we would care about, it would be August, because we only care when we can only start recording depreciation when the asset is actually in use, which does not need to coincide with the moment of purchase. So keep that in mind. So August of 99, that's when it starts recording depreciation, and then we're going to sell it when it will be in use until December 31st of 2030. So December of 2030. We don't care about the days, we only care about the months. and the year. We never care about the days, regardless if we're talking about personal property or real property. When talking about personal property, we only care about the years because we use the mid-year assumption. When talking about real property, we care about the month because we use the mid-month assumption. So, August 99 and December 2030. Let's put here the years, right? The depreciation rate, and then we can write the basis so that we get the depreciation amount per year. So it's 1999 is year 1, and then 2000 is year 2, and they want 99, 2000, 2029, and 2030. So note that the year 2001 will be year 3. So the year 2029 will be year 31st, and the year 2030 will be in fact the 32nd year we were recording depreciation. Make sure you don't mess up this. Usually people forget the year 0, right, when we're talking about crossing over decades. So be careful with counting the years. Resort to counting it by finger if you need to, but be very careful making sure you know what actual year we're talking about in the recording books. So if you do 2030 minus 1999, you'll get 31 as the difference, when in fact the year 2030 is the year 32. So be very careful about those computations. Now let's get the depreciation rates. So we are on page 68, and note this. So they say we buy it in August. This is the rate we're going to use. August, table 4, we use this 0.96% as the depreciation rate. For the upcoming years from year 2 to 39, we're going to use the 2.5641%. And if we were to reach year 40, then we would use the 0.16, or to say 1.6%. But we don't get there, right? We're selling it in 2030, which is the 32nd year. So it's somewhere in between, right? So this is the amount for the year 2030 if we were to keep it all year. But we are not, so we're going to need to make adjustment for that last year depreciation rate. So let's write here the depreciation rates. I don't need the year. This one, the in-between years, still the same rate. And for the last year, if we were to keep it, the entire year would still be the same amount, but we are selling it. And we are selling it in December, okay? And the textbook said December 31st, right? So those that are not knowledgeable about the US method would say, well, December 31st is the last day of the year, so I'm going to take the entire amount. There's no adjustments to be done. That's, sloppy thinking that gets you to miss points. So what does the textbook say about the mid-month assumption? It says that regardless of the day, the month counts as half. Kind of similar to what we discussed personal property, right? Personal property used the mid-year assumption, which said regardless of which month you buy it, for that year you can only record half, regardless if the year of purchase or the year of sale, right? Or the last year you can record depreciation in your books. Right? So here, which the year of sale, which is the last year, you can record depreciation for your books because you don't have it next year, right? You need to apply the mid-month assumption yourself, okay? Because the IRS doesn't guess when you're going to sell it, right? If you were to keep it for the entire 39 years of life, then you just take the numbers from the table. But if you are selling it before that, then you need to do computations by hand. And that's the case here. We need to adjust this rate to taking into account the mid-month assumption. So we're selling it in the month 12. The last month of usage counts as half, regardless if you stop using it in the first day of the month or the last day of the month. Counts as half. And we are selling it in December, right? So it means that we used it until November, the entire month. So for the year 2030, we're going to declare to Uncle Sam 11.5 months of usage. Half for the month of sale, and then the full months we used it in that year. We're selling it in December, so half for December plus the 11 months up to November. And then we divide by 12, which is the number of months in a year. So this ratio is going to give you what is the portion of this annual depreciation rate that I can record in my books. It's going to be very close to 2.56%, but it's not 2.56%. What if you're selling it in July of 2030? What will be this number? 6.5, right? Or if you were selling it in January of 2030, then this number will be just 0.5, right? If you're selling it in February, 1.5. If you're selling it in October, 9.5. Okay, so the last month always counts as half. That's what you write on the top. In the numerator of this ratio is the months of usage, okay, that you can declare, divided by how many months in a year. Right? So let's just simplify this to 11.5 because we are selling it in December. And then we would multiply all these, right, by the basis. Right? Remember this, the amount of depreciation is equal to the depreciation rate times the basis. The basis was the 2.4 million. So this will be multiplied by 2.4 million. So how much in depreciation for the first year? 2.4 million times 0.009614. $22,707.36. Then the in-between years would be 0.025641 times 2.4 million. So this is 61,538.4. This in between years is also the 61,538.4 per year, 61,538.4, and this last year is basically this amount times 11.5 divided by 12, which is 58,974.3. So this number was actually wrong. This is the multiplication, but somehow I messed it up. And you should have here 23,073.6 is the actual number. Okay. So how much depreciation in total have we recorded in the books? Well, remember we kept the asset 32 years. The first year we record $23,073.6 as depreciation. In the last year, the 32nd, we recorded 58,974.3, which means that in between there were 30 years of $61,538.4 recorded as depreciation, right? So it was this year, it was this, and there was 2018 over there. In total, 30 years at $61,538.40. So the total depreciation recorded in the books was the $23,073.6 plus 30 years at 61,538 0.4 plus the $58,974.30 for a grand total of $1,928,000 and $199 plus 90 cents. So that was the total amount of depreciation recorded in the books over these 32 years. That is the same to say from 1999 up to 2030. So let's put that information over here. Alright, so what is the net cash flow from salvage value? Remember the formula. Salvage value minus taxes paid on potential capital gains or losses, where the capital gain or loss is assessed by doing the difference between the salvage value and the book value, where the book value is equal to the basis minus the summation of all the depreciation recorded in the books up to the moment we stop using the machine. So it says that it's sold for $500,000. It's not an estimated salvage value, it's actually the price it was sold for, right? Net, right? So $500,000 minus the tax rate of it was 30%. It was written here before. Then again $500,000 for the salvage value, actually sold value, right? If you want to think it like that. Then the basis, right, of 2.4 million minus the value of the depreciation recorded in the book. So $1,928,199.9, which means that in our books, the difference between these two numbers, the asset still worth, let's write down all these. In our books, the asset still worth $471,000 plus $800.10. So this is the book value. The difference between the basis and how much it already depreciated. So in our books, the building's still worth $471,000. So we're selling it for $500,000 and it's worth less than that in our books. So we made a profit with the sale of how much? $28,200 approximately. So 500,000 minus 0.3 times $28,199.9. This is our capital gain. We made $28,000 of profit with this sale, capital gain, because we got 500,000 and the asset still was worth 471,000, right? So we're gonna give to Uncle Sam 30% of this $28,000 in taxes. So how much are we paying in taxes? $8,459.97. So in our pocket, we end up with $500,000 minus the taxes we owe. So $491,000 plus $440.03. This is the net cash flow from salvage value. So this formula is very informative, right? To get to this formula, you need to compute all the depreciation amounts. Then I can ask you, what is the book value of the asset at the moment of sale? That's just this part of the formula. That's the book value, the difference between the basis and the summation of all the depreciation to that moment in time. We found it to be the book value of $471,000, right? If I ask, okay, what was the capital gain or loss you had with that sale? That's between these two parentheses, right? The salvage value minus the book value That's the capital gain or capital loss. That's what we found to be a capital gain of $28,200 approximately. All right? Then I can ask, okay, how much do you owe in taxes from this sale? Then this will be the expression to compute that, and we found out to be $8,500 approximately. And then I can ask then the grand question, which is, what is the net cash flow from salvage value, the entire thing, right? Oh, that is $491,000, 0.5. So very informative, includes everything you need to learn in chapter 5 in a single type of exercise. That's it for now. See you in chapter 6.